So what causes the run to gold, of course, is that final confidence factor that everyone is, not everyone, but many, many people are voting and saying that, the dollar is the best place I can be. It's the safest place I can be. I have the most confidence of anything I can do as I own the dollar. And that confidence shifts.
This video is brought to you by Reluctant Preppers. Click here to subscribe for free to reluctantpreppers.com.
And that confidence shifts for whatever reason. And there are many reasons out there that it could. And once that is lost, then begins the run to gold. And that's something that even the Federal Reserve can't really control. I mean, they certainly can control a great deal, and I admit that, but they cannot control the overall psychology of the market. And once there is a shift to the thinking that even this currency is something that I don't have confidence in, then there'll be a big run to gold. So is it imminent? No. I mean, look at the prices, look at what's going on in the markets, but I wouldn't focus too much on the price. I don't need a lot of emails telling me what am I saying. Of course, price is important, and that's how everyone measures things. But really, if you think about it, price is what varies, and the metal itself doesn't. I mean, an ounce is an ounce no matter what. That hasn't changed, and the number of ounces you have is really something to focus on, probably more than the price at times. At least I think about it in those terms. So it's a step down the pyramid. It's a step to safety. So what you might say, Elijah, is that what it could indicate is that the stock market may not be just the juicy, wonderful, fantastic place to be anymore, and some of the smart money is moving out of that market and into the safer investment, which would be currency and primarily U.S. dollar. So it's part of the process is the way I look at it. I look at it as if, these things happen, they have to happen. It's the way the system is set up. And as odd as it sounds that there has to be a run to the dollar before there's a run to gold. But remember, the dollar is extremely liquid, and so is gold. So it's a lot easier to move from, cash into gold than it is to move from a stock into gold, because you got to go from a stock into cash first and then from cash into gold. Well, if you eliminate that step and you're in all cash, or you have a great deal of cash or whatever, then the next step is, pretty much automatic. So again, it's part of the process. Take a look. You could probably find other articles on the extra pyramid. Trace Mayer of runtogold.com did an excellent job of really updating the pyramid. I put that in my article so people can see it. You can study this stuff, get an opinion formed by yourself, look at it, think about it, question it. But the dollar's been king, for a very, very long time. And you look at these currency failures that have happened around the planet. You look at, Zimbabwe, Argentina. You look at even a ruble at times, years ago, the Asian currency crisis that I'm old enough to have gone through. You probably were too young. But most of these places where they have a currency crisis run to the dollar. I mean, the dollar is what everyone believes in. And again, they believe in it until they stop believing in it. And it isn't a universal thing. It isn't like 100% of the population stops believing in the dollar. It doesn't work like that at all. It's a very subtle, small shift at first. But then the markets take hold and realize that somebody wants out of the dollar in a big way, or somebody is offing dollars, in other words, selling dollars. And selling for what? And if the gold market starts to rise substantially while the dollar is starting to crater, then since the dollar market is so large and the gold market is so small, you could see a huge shift. And I've lived through that already. I mean, I went and saw, or lived through the bull market of the 1970s. And I watched, silver go from $6 in January of 1979 to over 50 in January of 1980. So in a 1-year time frame, I saw a commodity go up over 800%. And gold, I was actually in the futures market, and I had, gold contracts at 300. In December, I had bought them like in September, and they were like December gold. And, those contracts, gold went to like 875 in the futures market, 850 on the spot month. So there was a time when I was watching, these two gold and silver markets just keep going up and up and up and up. And it was basically a buying panic. I mean, the main worry in those days was huge inflation and that the dollar was toast. And once Volcker came in and threw interest rates sky high, it quelled the markets and basically started a 20-year bear market. But the confidence factor in the dollar, I think, is misplaced. There's never been a fiat currency in the history of mankind that hasn't failed. And the fact is the Federal Reserve Board itself admits that the U.S. dollar from the inception of the Fed in 1913 to 101 years later today is worth roughly 4 or 5 cents. So that's about a 95% failure. And yet we're worrying about what this last nickel's worth of dollar is going to do. And I'm not saying the dollar doesn't have value or doesn't buy you something, but just in my lifetime, I look at, the price of gas or price of a home or price of an automobile. I mean, the price of an automobile today is what my father paid for a great middle-class house when I was in high school. So, the inflation is an insidious thing. And if it's slow enough, and it has been, then the confidence remains in the currency. But that doesn't mean it's going to remain forever. So I'm very long-winded, I think, on all of your questions. But I'm a deep thinker, and I'm not trying to be right. I'm trying to give a historical foundation and experience to let people that are in the sector know that, they should be fine. I think we're going to have our day. And one thing I want to emphasize, Elijah, is that, I try to balance not only my portfolio, but my life at large. And that, anyone that understands how much, let's say, management or control is in these markets realizes that you can have a position that certainly can go against you for quite some time and still be right. The problem with some people is that they get the impression that the only place to be is in perhaps the precious metals markets. And I certainly hope I've never given that impression. I certainly think it's extremely important. I think everyone should own precious metals. I truly believe that. But you don't have to own it in such size where it damages your well-being. If you can't sleep at night because you bought too much silver or bought too much gold or both, then you haven't balanced your situation. And people ask me, well, what else should you buy? And of course, I specialize in metals. I mean, that's really what I devote almost all of my time to. But as I said earlier, there are other asset classes. Several of the commodities are good, oil especially, although that's hard to invest in. In the futures market, I wouldn't recommend for anybody other outside the professional, but there's stocks, et cetera. So there are ways to balance a portfolio. I'm not going to give you that information because I'm not that's not really part of my expertise, but I do want to point out that, a 10 or 20% holding the metals is probably plenty for almost anybody.
For those who are interested in getting involved in the metals markets right now, I know you discussed on your interview with David Smith about the risk-reward ratio right now in the precious metals markets. Did you want to talk a little bit about that?
Sure. There was a book, in fact, one of my futures brokers owns it, and I may have it in my library downstairs, but it was a very fascinating title. It was titled, "You Can't Lose Trading Commodities." And of course, almost 97% of the people that ever enters the futures market end up losing and leaving. So what a title, "You Can't Lose Trading Commodities." So I bought the book and read it. And the premise of this book made a lot of sense. Basically, the premise is that if you can buy a commodity, doesn't matter which one, corn, wheat, ag, softs, metals, whatever, and you can buy it under the cost of production. You can buy it under what the farmer could grow it for. and you can hold on. And he's talking about contracts, not necessarily physical, but that's the beauty of the metals markets is you can buy it in the physical form and hold it. Whereas buying wheat in the physical form can be done, but where do you store it? So if you can buy it under the cost of production and have patience, you are going to make money. That's the basic premise. And I adhere to that. I think that that's valid. So the risk reward in silver and gold, I mean, both are basically under the cost of production for primary gold and silver producers. So the risk reward profile is extremely favorable to those that, one, can buy for cash, two, store it, and it's not hard to store, gold especially, but silver really isn't as bulky as most people think as far as, the amount of space it takes relative to another commodity like wheat or soybeans or anything else. Basically, it's very bulky relative to gold, but, you can put gold coins in your pocket that will buy, pretty good size, a nice automobile in your two front pockets, and walk in and pay for it in gold, and really no one's the wiser. In other words, it's a very small volume relative to the amount of value, even at $1,200 an ounce gold. So the point is that is a very, very favorable risk to reward profile, and the hardest job I think still lies ahead. And that is when these markets do bottom and they start back up, when we finally get, 3 years from now or whatever, and those markets are going higher and higher, and there's more and more momentum, and people are extolling the beauty of owning precious metals again, and, how bad the dollar is, and all that type of thing that we saw, once before in the, basically after the 2008 crisis, when gold and silver both were, went out with the bathwater and bottomed, and they had a spike low and started back up, running into April 2011 for silver and September 2011 for gold. I believe strongly you'll see those days again. But right now, of course, it's the other extreme. The sentiment is very low, but the profile, as far as a savvy investor, Mr. Market's making a big mistake. And if you have the wherewithal to add to your position, if you're so inclined, or start a position, certainly now is probably one of the best times. Does that mean that I'm saying that, silver is not going lower? No. I mean, the smart way to do it really is probably to buy it over the next, 3 months or so. I don't think this low is going to be here a very long time. I mean, we've been bottoming for the last 3 years in silver. And usually the type of run that we had from $19 all the way up to 48, when you get that kind of extreme parabolic move on the upside, usually takes 2 to 3 years to digest that kind of a move. And we're certainly there. We certainly have had enough time to digest that big move on the way, on the upside. A lot of the stale bulls that bought at 30 or 35 or 28 or whatever that have given up on the silver market have sold their silver back in the market. So only the strongest of strong hands own it right now, and there may be new buyers. Certainly it looks as if the Chinese have an insatiable appetite for the metals, that no matter what the price is, they just continue to buy.
So you've mentioned that once people lose confidence in the dollar, there will be a run to the precious metal markets. But in the meantime, while we're seeing the dollar strengthening, do you think it would be a good idea to possibly invest in the dollar to try to ride the wave, or would that not be a prudent decision, maybe considering that the risk-reward ratio might not be that good?
Well, I haven't really been asked that question a long time, but, put on my, thought experiment hat, and I've thought about this a great deal. I mean, if you really didn't know which way the economy is going to go, because there are deflationary forces and inflationary forces, and they are occurring at the same time, regardless, and being an Austrian, I'm not supposed to say that, but I will. And so if you really didn't know, I mean, the smartest place to be would be 50-50. And I'm just going to eliminate silver from the equation. You have, 50% of your assets in gold and 50% of your assets in cash. And, if the Robert Prechter scenario was right, you would be very, very happy because your paper assets would continue to appreciate in purchasing power, and your gold assets would probably not have as much value in paper terms. Conversely, if that scenario didn't play out, and the one that I'm more inclined to see play out in the future does, then you'd have 50% in gold in your paper cash asset would be going down, but at the same time, your gold price would be going up in value or in purchasing power. So that's a very, very simplistic way to look at it, but it's a good thought experiment for those that are concerned about, a deflation/inflation scenario. Which way do I play it? Well, you can play both sides, and that would be the way to do it. There's a lot made, and I'm probably one of them, that, cash is trash and all that. But let's face it, it is important. It's important to have liquidity. As liquid as gold is, cash is more liquid, really, in today's world, because you're not going to be able to make a transaction in gold very easily, in an everyday market. You're going to use, some currency of some type, depending on where you are in the globe, where you're located. So that's really important. And a lot of people think that you should be fully invested. But I learned, from about your age, Elijah, on, maybe even younger, that it's very good to have liquidity, some cash. No matter how good an investment looks and you think you're buying a low, it can go lower. Cash is sort of the way that we keep score. Even if you're a gold investor, most people don't keep score in how many ounces they own. Although, again, from my perspective, that's a good way to look at it, because it sort of eliminates the price pressure. But the way they look at it is, what is it worth? Is it worth $1,200 or $1,300? If it's worth $1,300, I feel better buying it at $1,200. But and I'm not trying to invalidate that. What I'm suggesting is that that's how we keep score. What's our cash position? What's our net worth? Everyone figures what their net worth is and how many dollars or Canadian dollars or euros or whatever currency is their currency of their location determines how they feel about what their net worth is. But we got to look at, the real wealth and the real economy versus the financial markets. The financial markets are so distorted relative to what the physical underlying economic system is that there's a huge distortion. And that's the problem, and it's getting worse, and that goes back to the upside-down pyramid. You have a system that continually has to expand exponentially, whereas the economy itself is not doing that. In fact, you can make an argument that in some sectors it's actually contracting, not growing. So the physical economy could be contracting at the same time that the financial system has to expand. And at some point, recognition of that problem is going to manifest. And again, when it does manifest, people are going to go to whatever they feel is more important than whatever asset class they hold. And the asset class that they hold that has the most risk are the ones that are going to dump the fastest, and those are the ones that will drop the most. And since the biggest pool of assets are basically in the most toxic waste imaginable, which is the derivatives market, once that starts to unravel, there'll be a move down the pyramid that will be quite substantial.
Hey everyone, thanks for watching. That's it for part 2. Make sure to click here to subscribe so you will be notified when part 3 is released. This video was brought to you by ReluctantPreppers.com. Click here to watch part 2 of Reluctant Prepper's latest interview with Bill Murphy, where Bill Murphy explains why manipulation of the gold and silver markets have caused their prices to decouple from their fundamentals, and why now is a historic opportunity to get started and increase holdings of gold and silver. And finally, where you can get solid, trustworthy information on precious metals.